Meet Marcus. He's 31, works in logistics, makes decent money, not great, not bad, lives in a mid-sized city, drives a 4-year-old car, has a coffee maker he's proud of. On paper, Marcus looks fine, but every morning, before he gets out of bed, he does something. He picks up his phone. He opens his banking app. He looks at the number, and then he closes it. Not because he forgot what it says, because he already knows. And knowing doesn't help. You probably know someone like Marcus. You might be Marcus. Here's what nobody told him, what nobody tells most people, before any of this started. Debt doesn't just change your balance, it changes you, your decisions, your relationships, your sense of what's even possible. And it does it so gradually that by the time you feel it happening, you've already been inside it for years. Today, we're going to map it. All of it. From $0 owed to 100,000 in the hole. Not theoretically, not in a spreadsheet, in real life, in behavior, in the specific, quiet ways each level rewires how you think, what you do, and what you stop believing is available to you. And here's what's different about this. We're not stopping at the diagnosis. At every level, we're going to look at what actually moves the needle, because understanding the trap isn't enough if you don't know where the door is. This is your life at every debt level. Before we go anywhere, let's establish one thing clearly. Debt is not a moral failure. That framing is for self-help books. A mortgage on a home that appreciates is debt. A student loan that moved you into a higher earning bracket is debt. A business loan that let you hire people and build something is debt. Debt is a tool. What matters is whether it's working for you or against you. The problem isn't debt itself. The problem is that nobody gives you the map before you're already deep in the territory. So here's the map. Level 1, zero debt. Marcus, 3 years ago. No balance carried from month to month. No personal loan. No buy now, pay later tab quietly ticking in the background. Just nothing owed. You'd think this would feel like wealth. It doesn't exactly. What it feels like, according to almost everyone who gets there, is lighter. Not rich. Not even necessarily secure. Just lighter. When you owe nothing, every dollar you earn is, at least in theory, yours to direct. You're not running a treadmill where a percentage of your paycheck is already spoken for before you decide anything. You have what finance calls optionality. That word sounds abstract until you actually have it. Optionality means a car repair is an inconvenience, not a crisis. It means you can quit the job you hate without a countdown clock in your chest. It means no is a complete sentence in financial decisions. Zero debt doesn't mean wealthy. It means you're playing with a full hand. Here's the uncomfortable part. This is also the exact moment the system is most aggressively trying to get you to give that up. What to protect at this level? The feeling of lightness is real data. It's telling you something about what your financial baseline is capable of. Before you take on any new debt, ask one question honestly. Is this debt moving me somewhere, or is it just making something more comfortable right now? Those are very different trades. Level 2. $1,000 to $5,000. This is where Marcus's story actually starts. A credit card, used during one slow month when the transmission went. He told himself he'd clear it by the end of the quarter. That was 18 months ago. At this level, most people aren't worried. And honestly, that's not irrational. $1,000 in debt with a $25 minimum payment. You can see the exit. The math is manageable. But here is what's actually happening underneath the surface. You've gotten comfortable with a balance. Psychologists call this debt normalization. The moment you carry a balance through a billing cycle without consequence, without anything bad happening, your brain quietly updates its model of what's acceptable. The number becomes background noise. You stop flinching at it. And when it grows slightly, the recalibrated brain barely registers the change. This is not weakness. This is how humans process gradual change. We notice sudden shocks. We are almost completely blind to slow drift. Between $1,000 and $5,000, something subtle and important shifts. You stop asking, when will this be gone, and start asking, can I handle the payment? Those are profoundly different questions. One is about elimination. One is about management. And management, once it becomes the default mindset, is a road with a very specific destination. What to do at this level? This is the easiest level to escape from, and the easiest to ignore. The window where $1,000 can be eliminated in 3 focus months exists right here. It closes faster than it feels like it should. Level 3. $5,000 to $15,000. Now the math stops being abstract. Now it's physical. $15,000 in credit card debt at an average US interest rate of around 20%. Minimum monthly payment, roughly $375. If you pay only that minimum, and most people do, because it feels responsible, because you're keeping up, you'll be in debt for over 40 years. You'll pay more than $45,000 total on a $15,000 balance. You borrowed 15. You will return 60. The bank manufactures money directly out of your time. Here's what makes this range almost elegant in its cruelty. $15,000 still feels fixable. It doesn't feel catastrophic. You can build a story, a promotion, a tax refund, a side hustle. The illusion of a clear path stays intact just long enough to prevent the structural change that would actually help. And so most people at this level don't change their behavior. They manage, but compound interest doesn't manage. It executes, silently, every single day. Marcus is here now, and something else has started happening that he hasn't quite named yet. He skipped his dentist appointment last spring, not because he didn't have the cash that week, because the anxiety of the balance made all spending feel dangerous. He said no to a weekend trip with his college friends, told them work was busy. His social life has quietly started bending around a number on a screen. That is not a financial problem. That is a psychological one. What to do at this level? The single most important move at $5,000 to $15,000 is stopping the bleeding before attacking the balance. That means no new debt, full stop. Then look hard at a balance transfer to a 0% introductory rate card. That one structural move can buy 12 to 18 months, where every payment attacks principal instead of interest. It won't solve everything, but it changes the math in a way that willpower alone cannot. Level 4. $15,000 to $40,000. This is the level where debt stops being a problem you have and starts being a system you live inside. At $40,000 across multiple accounts, credit cards, a personal loan, a car note that was a stretch, you're likely allocating between $800 and $1,200 a month just to service the debt. That's before rent, before food, before the basic cost of being alive. And now, the cascade begins. Research from Princeton and Harvard shows that financial anxiety doesn't just feel bad. It occupies cognitive bandwidth. The mental load of managing chronic financial stress measurably reduces the brain's capacity for long-term planning. People under this kind of pressure make worse decisions about money, not because they're less intelligent, because scarcity consumes the processing space that future thinking requires. You become, almost mechanically, more present tense. The future starts to feel theoretical. Retirement contributions get paused or reduced. Investing stops. Every decision gets filtered through one question: can I make it to the next payment? This is the quiet horror of this range. From the outside, nothing looks wrong. You still have a job. You still show up. But inside the architecture of your daily financial life, almost every decision is downstream of the debt. It is load-bearing. You can't just remove it without everything shifting. What to do at this level? This is where most solo efforts stall, not from lack of discipline, but because the math genuinely requires strategy. A non-profit credit counseling agency, not a for-profit debt settlement company, the distinction matters enormously, can often negotiate interest rates down to 6 to 8% through a structured repayment plan. That single intervention can cut the repayment timeline in half. This level requires a plan, not just effort. Level 5, $40,000 to $75,000. Here is the specific mechanism most people never see until they're already inside it. When your debt-to-income ratio climbs past a certain threshold, your cost of borrowing increases. Your credit score softens. You get offered worse rates. You may get denied for the balance transfer that could have given you real breathing room. The very tool that could have helped you escape becomes harder to access, because the system reads your balance as evidence of risk. Higher debt makes borrowing more expensive. More expensive borrowing makes the balance harder to control. A harder to control balance drives the number higher. This is not a design flaw. This is the design. At this level, something else happens that researchers in financial psychology have documented clearly. People with high consumer debt show elevated rates of shame, social withdrawal, and avoidance behavior around money. They stop checking accounts. They stop opening mail, not because they don't care, but because the information feels threatening, and the brain, trying to protect itself from pain, treats a bank statement like a physical danger. Avoidance makes everything worse. The balance doesn't pause because you stopped looking. Marcus is here now, and for the first time, he started to wonder if the life he imagined, owning something, building something, having some version of choice, is actually available to him. That thought, quiet and persistent, is one of the least discussed costs of debt at this level. What to do at this level? At $40,000 to $75,000 in consumer debt, the single most important thing to understand is that debt payoff and wealth building cannot happen simultaneously at full speed. This is the level where sequencing matters. Stop all non-employer matched retirement contributions temporarily. Direct everything to the highest interest debt using the avalanche method. This feels counterintuitive. It is mathematically correct. Now, here is the thing that reframes all of it. This is the part nobody puts at the beginning, because it only lands once you've seen the whole map. Credit card companies have an internal term for customers who pay their balance in full every month: deadbeat. That is the actual industry word, because that customer uses the infrastructure, collects the rewards, builds the credit score, and generates zero interest revenue. From the company's vantage point, they are a cost, not a profit. Every design choice in the product suddenly makes sense when you understand that framing. The rewards programs keep you engaged. The grace periods feel generous. The minimum payment looks responsible. The automatic credit limit increases feel like trust. Every element is calibrated to keep you in one specific zone. Enough debt to generate profit, not enough to trigger default. They don't want you in debt forever. They want you in debt for exactly as long as possible. The levels you just walk through aren't random. They are the predictable output of a system that was optimized to produce them. Level 6, $75,000 to $100,000 plus. Let's be precise about what this number means for a real person. The median US household income is roughly $75,000 before taxes, health insurance, and retirement contributions. After deductions, take-home pay lands around $52,000 to $55,000. $100,000 in consumer debt means you owe roughly 2 full years of your entire take-home pay. Every dollar. No rent, no food, no transportation, just covering the principal. That doesn't account for the interest accumulating the entire time. At this level, individual effort is no longer the primary variable. You cannot hustle your way out of this in any meaningful time frame. Not through overtime, not through cutting expenses, not through a side hustle that generates an extra $500 a month against an interest burden that generates $1,200. Debt consolidation, bankruptcy protection, negotiated settlement. These are not failures of character. These are financial tools that exist precisely because this outcome is mathematically predictable at large enough scale. Bankruptcy wasn't invented to punish people. The Romans had debt relief mechanisms. Medieval England had structured debt forgiveness. Nearly every complex economy in history has built a legal release valve. Because without one, consumer debt systems eventually consume their own participants. $100,000 in the hole is not a personal failing in isolation. It is a person-sized data point in a much larger pattern. What to do at this level? Get a free consultation with a bankruptcy attorney, not to file immediately, but to understand the full landscape of options. Chapter 7. Chapter 13. Negotiated settlement and debt management plans. Each have different consequences and different timelines. Understanding all of them is not giving up. It is finally playing the whole board. Here's what I want you to take away from all of this. At zero debt, you have more power over your financial direction than at any other point. Most people give it up gradually, in small increments that each feel justified in isolation. At $100,000, you are not a different species from your zero-debt self. You are the same person who made a series of individually reasonable-seeming decisions inside a system that was specifically optimized to produce that outcome. The villain, if there is one, is not the debt. It's the opacity. The fact that most people enter credit products without a clear map of where those products are designed to take them. You now have the map. Level 1, guard the lightness. Level 2, eliminate before you normalize. Level 3, stop the bleeding, then restructure the rate. Level 4, get strategic, not just disciplined. Level 5, sequence correctly. Level 6, use every tool available. Marcus, by the way, is fictional, but his situation is not. There are tens of millions of people sitting exactly where he is. Smart, hard-working, not sure how it got this far, not sure what to do next. The difference between the person who finds their way out and the person who doesn't is rarely intelligence or discipline. It's almost always information. If this gave you something useful, a word for what you've been feeling, a clearer picture of where you are, share it with someone who might need it, not as a warning, as a map. Because the single most powerful thing that can change someone's financial trajectory isn't a budgeting app or a debt calculator. It's understanding what's actually happening to them and why. And if you want to know what to do with this information, not in theory, but specifically based on your actual numbers, The next video covers the exact order of operations for getting out of consumer debt at every level we just walked through. Not the version that tells you to cut lattes, the version that actually works with real math and real constraints. That one's next.